Duolingo stock is down over 60% in the past 6 months, and it fell almost 30% in a single trading day after their earnings report. Although the company beat on top and bottom line and reached 50 million users, the company fell because of guidance and AI concerns. In this video, we'll see if this is a good opportunity to buy the company by looking at the fundamentals and running a DCF model to calculate the intrinsic value of the company and potential future returns. Duolingo has seen impressive revenue growth over the past 7 years, growing from $70 million to $964 million currently, which is a compounded annual growth rate of 45%. Analysts are expecting revenue growth to decrease in the next couple of years, as Duolingo is expected to grow to $1 billion this year and reach $1.6 billion by 2027, which is a compounded annual growth rate of 26.5%. I also believe the company is going to continue to grow because booking, paid users, and subscriptions are growing at a very fast pace. Duolingo recently turned profitable, and they are currently making $386 million in net income and $354 million in free cash flow, and profit is expected to keep growing as they are expected to make $3.33 per share this year and grow to $6.36 per share in 2027. If you assign a 20p to the company then, it would make it a $127 stock, meaning negative 33% returns. So not a lot of returns according to analysts. And I also believe their profit is going to grow a lot because they have great margins, with gross margin being 71%, profit margin 40%, and free cash flow margin 36%. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $117 per share, middle $197, and high $338. And because the stock is currently trading at $192 per share, this means that if my low assumptions occur, you would make a 1.5% annual return on your money, middle 10.4%, and high 20.4%. As far as my assumptions, I assume Duolingo grows revenue between 7 and 18% in the next 7 years, the average of profit margin and free cash flow margin between 30 and 40%, and I assign the P/E price to free cash flow at the end of the 7 years of 16, 18, and 20. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Moreover, Duolingo is currently trading at a P of 23 and price to free cash flow of 25. And therefore, we can conclude that the company looks fairly valued, and before this drop in price, the company was heavily overvalued as it was trading at a P around 50. Duolingo has also an amazing balance sheet as they have $1.1 billion in cash and only $97 million in debt. And in conclusion, I believe the stock has fallen, not because their earnings news, but because of the valuation. I actually believe this is a company that is going to benefit from AI, not suffer from it. And even though the stock has become cheaper, I don't believe it's cheap enough. In my opinion, it would still need to fall another 15% in order for me to consider buying. Lastly, if you want a discount on stockanalysis.com, the best place I found for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Duolingo stock in the comments, and I'll see you in the next one.